Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the NR4 trading strategy, a powerful technique that can help you spot potential breakout opportunities in the market. This strategy focuses on identifying periods of low volatility that often persist or precede strong price movement, giving you a clear edge in timing your trades. Stick around with me until the end of this video to learn how to effectively apply this strategy, including how to set up your entries, exits, and manage your risks for optimal results. Now let's look at what the strategy is all about. The NR4 strategy, which stands for the narrowest range of 4 days. The narrowest range of 4 days is fundamentally a volatile-based trading approach that identifies potential breakout opportunities. When a trading day range becomes narrower than the previous 3 days, it signals a compression in price volatility that often precedes a significant price movement. Now let's look for an example of this NR4 candle. They said a small candle that is smaller than the previous 4 days candle. A small candle smaller than the previous 4-day candle. As we can see, this is an example. This particular candle is a small candle. This candle is a small candle, smaller than the previous 1 to 3 days candle. This is an example. Let's look for another example. This one is also an example. This candle is smaller than the previous 4-day candle. Is smaller than the previous 3-day candle. The fourth candle is the one smaller than the previous 4-day candle. This is also another example of NR4 candle. The strategy works by measuring the daily price range calculated as the difference between the high and lows of each trading day. When you spot a day where this range is smaller than the previous 3 days, you have identified a NR4 pattern. This compression typically indicates that market participants are in a period of indecision or accumulation. The beauty of this strategy lies in its versatility. You can apply it across any currency pair and it still remains effective in both trending and ranging markets. However, its reliability increases significantly when combined with key support and resistance level or a technical indicator. Now let's look at the trading rules for this strategy. Let's break down exactly how we can execute trade using the NR4 strategy. The key is to wait for confirmation of the breakout direction rather than trying to predict it. Now, firstly, the first rule for a long position, identify the NR4 bar on the daily time frame. This is an example of the NR4 bar on the daily time frame. This is also an example of the NR4 bar on the daily time frame. You place your buy stop order 2 to 3 pips above the high of the NR4 bar. That ensures that you only enter when price breaks out of the compression zone. That means in this example, we'll set our stop loss 4 to 3 pips above the NR bar. This is the NR bar. This candle, let's not forget this particular candle. The candle of the 4th day of July. This candle is the NR bar candle. We set our stop loss, our entry just above 3 to 2 pips above, giving it enough allowance so that we would not enter the trade and it will quickly reverse on us. let's not forget that for the short position, it is the same thing. Let's look for a short position trade. We look for, okay, this is an NR candle. This candle is smaller compared to the previous 3-day candle. This candle here, the Monday 4th of November 2024 candle is smaller compared to the previous 3-day. So in case of taking this trade, you put your sell position 3 to 4 pips below the candle, the NR4 candle. Let's not forget our stop loss should be placed beyond the opposite end of the NR4 bar. For long position, we place it below, while for short position, we place it above the NR bar, or you can place it above the previous structure high or low in case of a sell position. Then in case of a buying position, you can put it just below the candle, or you can put it after the series of the 4 candles, the lowest point at the series of the 4 candles, or the lowest structure point, just to safeguard and give your trade some room. Now for take profit, the recommended approach is to target a minimum of 1:3 risk to reward. However, you can also use previous swing highs or low as logical targets for your trade. You can use previous swing highs or low, like this previous swing high over here can be your take target profit for this long position. You can use previous swing high or low as your take profit target. If you don't want to use 1:3, 1:2, you can use that. In case of a short position, you can use previous structure high or low. Here is a previous low. If you don't like this low, you want to go lower, you can go for this low. Anyhow you want to target, always make sure that you are in the right direction of price. You are trading according to the trend of the market. Now let's look at additional confirmation. Trade in the direction of the large trend. Always trade when you see the market is trending in that direction. Why we took this trade was because if we look at it, the market is trending downward. It made a series of lower highs and lower lows, breaking the previous structure, showing that price has changed bearish. So this is a bearish trade. Then in case of the bullish trade, we took it because price was making a series of higher high and lower higher low, trending in the up direction. That was why we took the trade. So your first confirmation should be you are trading in the direction of the large trend. Your second confirmation is you look for the NR4 pattern near key support or resistance level. As you can see, this pattern came into play close to the market resistance point, key resistance point. At this area, the pattern came into play at a key resistance point. This was a previous low. This was also a previous low. At this area, price was finding it difficult to break this zone. If we extend it, we can see that this was a previous high and a previous low, the previous resistance that price broke out, and it became a support when price broke out completely. Then the third thing we need to consider is our volume. We need to consider using our volume indicator. We analyze using the volume analysis for additional confirmation. At this area where we decided to take the trade, we noticed that there was volume in the market. You can see the volume in the market was there. Even at this area, we can see the volume was there in price. At this area too, there was volume in the market. Then the fourth confirmation that filters this trading strategy is avoid trading during major news events. When there is a major news event coming up, we need to avoid trading in this market condition. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you would never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.